Good afternoon and welcome everyone to the DineCo Conglomerate webinar supported by our lovely presenters today. The webinar Swimming Against the Tide. I'm Shane Dean. I'm Director and a Registered Liquidator at DineCo Insolvency Practitioners, and I have the esteemed privilege of presenters today. And we've got a fantastic lineup of presenters who are going to help everybody through navigating the toughest parts of COVID and the things that we're all facing at the moment. So our fantastic lineup consists of Andrew Knowles and Martin Lakos from Macquarie, Stephen Mitchell, CEO of Oak Capital and Resicom, which are now combined into one business. Speak to Stephen later if you want to understand about all the things that are happening there. Olga Koski, Director of Taxassure, Luke Egan from Astor Alliance, Arthur Athanasopoulos, and I said it so well earlier too, Arthur, from Cashflow Finance, Tony Eldred Hospitality and the Director of the San Telmo Group, and Nick Giassimo also from DineCo. So why is it called Swimming Against the Tide? From our discussions with accountants, advisors, business owners, the common theme felt like they can't really do anything, or they're not getting anywhere with some of the options that were available to them, and it felt like that they were swimming against the tide. In other words, expending energy and not getting anywhere. And what's harder than swimming against the tide is doing it in the dark. So you can't see the rocks, you can't see the reef, and if you stop swimming, you can't even see how far you've now drifted out to sea. So this webinar is designed to basically be a lighthouse, removing the dark, providing the options for all the advisors and the clients to navigate through the rough seas, or in the most serious of cases, provide the life raft, keep you off the rocks. Businesses at the moment are heavily reliant on the flotation devices provided by the federal and state governments, by the way of JobKeeper, ATO deferrals, grants moratorium, insolvent trading, all that sort of stuff. But if anyone's read the bold disclaimers that go with those floaties, it always says they're not to be used as a life-saving device. And this is how we should be viewing these initiatives. Already a lot of them are being wound back. It won't be around for forever. ATO is going to start recommencing recovery action. They're going to want some money in. And businesses are going to start to trade again in some capacity. So how do we navigate that, survive, and then thrive? So the presenters today, they're going to be part of your own lighthouse, and whatever that looks like for your business or for your clients' businesses or whatever that might be. We're going to hear what we can expect in the market going forward, what it currently looks like. We've just had a budget. What the access to capital is going to be like, the different forms of capital that can be accessed. The two of the major sectors are being absolutely slammed at the moment, both hospitality and construction. We're going to hear from experts on that. Dealing with the ATO, who are quite often the major creditor in a lot of businesses, and put some pressure on businesses, how to negotiate, get around that. And finally, some options around dealing with the worst case scenario and trying to make the business remain viable. So without any further references to anything nautical, I've done enough of them. So it's time to get along with the webinar. Now, each presentation is going to go for roughly 10 minutes, maybe a bit longer. By all means, chuck your Q&A chat into the chat box. If we've got time, we'll get the questions answered. If we don't have time, we'll move on. And those questions will be answered by email via the presenters over the next 24 hours or so. So without any further ado, I'm going to our first speaker, Andrew Knowles from Macquarie. And I'll just transfer it over to you, Andrew. And I better take you off mute.
There we go. Thank you, Shane, and good afternoon, everyone. My name is Andrew Knowles, and I'm the National Segment Head for the Insolvency Industry at Macquarie Business Bank. Now, at Macquarie Business Bank, we specialise in providing cash flow goodwill lending to SME and emerging corporates, and to support such things as working capital requirements, succession planning, and M&A activity, as well as tailored and specific transactional banking and genuine thought leadership. Now, we're not a one-size-fits-all bank, and we only bank certain industries and certain businesses within those industries. This allows us to go deeper and provide more flexible and tailored solutions. And those three streams are professional services, accountants and financial planners, legal firms, insurance brokers, and of course, insolvency. We have property services, which is lending to real estate agents and commercial agents, strata managers, as well as property-backed lending, such as commercial property portfolios. And our newest stream is business services, so lending to the built environment, so architects and consultant engineers, the health sector, as well as technology. Now, I'd like to welcome Martin. Martin is the face of Macquarie's economic updates, and it's such an interesting point in time given the recent events with the budget, the US election. So we thought we'd get the experts in. So with that, I'll throw it over to Martin.
So it's my job this afternoon to take you through Macquarie's view of the world in 10 or 15 minutes. So this is going to be a very quick crash course in terms of our overall big picture view. Obviously, we need to be looking where we are today and where we're going tomorrow, but very quickly, where were we coming from? In 2019, we certainly had the world, in terms of global growth, modestly improving. This was well after a time that we had the trade war, which would partially got resolved by the phase one trade deal, and also that we had the US Central Bank, who had started to raise interest rates in 2018, trying to combat the risks of inflation. They basically started to reverse that policy. Of course, going forward, we had the coronavirus emerge in January and February of this year. And of course, we had a significant shutdown in the Chinese economy. Now, given where we've come from, the IMF, the International Monetary Fund, is forecasting that global growth is going to decline this year by about 5% across this whole year. But they are actually forecasting a rebound of some 5%. And the main reason for that is largely the amount of significant activity and policy response by central banks and governments around the world. Now, how much do we gauge as that policy response? Well, certainly looking back at the GFC, central bank activity in terms of cutting interest rates and adding liquidity into global banking systems and into economies is about 3 times that was put in place at the time of the GFC. Equally so, if we have a look at the amount of fiscal response from governments, and obviously we've had the most recent one through the budget on Tuesday, it looks like it's about double that we saw at the time of the GFC. So this is a breathtaking, significant amount of policy response by central banks and governments. Now, despite this response, there's obviously still risks out there. And the key risk we still continue to focus in on is obviously, unfortunately, what Victoria has experienced, which is a secondary flare-up of COVID. Now, quite clearly, we wouldn't want to see that anywhere else here in Australia, but we are seeing it once again emerge as a secondary flare-up in Europe, in the UK, France and Spain. And really it doesn't look like, to some extent, the US has yet seen the end of its first round of COVID impacts. And so how do governments respond to a secondary flare-up? Equally so, we are expecting that if economic data is worse, that'll have a negative impact on confidence. Now, we do know that the economic data is awful. Every major developed world economy around the world is in deep recession. And of course, this is the worst time to have a geopolitical conflict between the US and China, where relationships have deteriorated further. And quite clearly, Australia is experiencing the blowback on that, with China putting tariffs on barley, wine, and on meat. But the biggest risk we see in the very, very short term is the US election, only because we don't know the outcome, number one, and number two is to try and gauge whether there's significant policy difference between the Democrats and the Republicans. Certainly under normal circumstances, the Republicans are more pro-business, and we've seen that from Donald Trump's policies over the last 4 years, cutting taxes, cutting red tape, and investing in infrastructure. Now, don't get me wrong, Donald Trump is not on my personal moral radar, and I certainly personally feel that he's a flawed character. But we don't think that a Joe Biden administration will in fact significantly change the settings. In fact, the global financial markets look like they're now accepting a Biden or the potential of a Biden win, and that a Biden administration may in fact add additional stimulatory action and policy into the US economy. Now, as a result of this significant activity by central banks and governments around the world, Macquarie took the view in April, and it's still very much our view that we will see, and we are in the middle of, a V-shaped recovery. That is, we're coming off the bottom. But the question mark is, how long will it be before we can get back to the same rate and pace of growth that we had in 2019? So that duration question is absolutely key. As far as we can currently see it, we think we're at least 2 years, maybe 3 years away. And of course, if any of those key risks arise, that V-shaped recovery turns into a W-shaped recovery. That is a rebound, a secondary sell down or decline, and then a final rebound. Now, interestingly enough, Australia is actually faring better than most, relatively speaking, against the other major developed world economies and our major trading partners. And we are certainly expecting that we are going to see a rebound and certainly off the bottom in our economy going forward. Now, of course, all of this stimulatory action is basically coming from the fact that central banks have cut rates and adding liquidity into the economies, and governments are raising or using an enormous amount of debt to support economies through policy changes. Now, of course, the big question is the level of debt, which is the highest it's going to be since World War II. That's certainly the case for Australia. Is how affordable is this debt? Well, given interest rates around the world are very, very low and are likely to be very, very low for quite a number of years, we're now seeing government debt rates at the lowest they've been since 1967. That means that we think the debt serviceability is actually very acceptable. Now, quite clearly, we want to see governments acting responsibly on the fiscal side and look to reduce debt as quickly as they can. But they can certainly manage this debt for quite a number of years. In terms of Australia faring better, well, the IMF, the International Monetary Fund, put out forecasts in April, as you can see by this chart, the orange bars. And at that point in time, they were forecasting Australia to have negative growth of 6.5%. In June, they revised these outlook and in fact improved Australia's outlook, still negative, but negative 4.5%. And that compared quite favourably against a number of our trading partners and leading developed world economies, where they saw significant additional downgrades to their outlook. So once again, we seem to be in a slightly better position. Basically putting in place our view that there is a V-shaped recovery, there's a whole range of data points taking place around the world that would suggest we are well and truly off the bottom. Now, this is this chart in front of you is actually quite surprising. Mortgage applications are rising. Now, this is despite the fact that we've still got very high unemployment in the United States. But the reason we think this is taking place is the availability of credit. So we are seeing that with obviously very low interest rates, we didn't see as large a fall in property prices. In fact, in the US, property prices are actually now up. We've seen a significant pickup in activity by households in regards to mortgage applications. But this is duplicated around across a number of key segments. If we look, for example, in retail, at pharmacy and consumer staples, both here in Australia and the United States, we're almost back to where we were in terms of activity levels since in 2019. If you have a look at mobility, so transportation, this time last year, there was about 220,000 flights, including cargo flights, around the world per week. That got down to as low as 80,000 flights in the March-April period, and we're now back to about 140, 150,000 flights. So although not back where we were last year, well and truly off the bottom. Certainly other data points would suggest that car sales is suggesting that households are starting to get activity again, as are some businesses. Interestingly enough, as in this chart, you can see car sales in China are almost back to where they were in 2019. This is to some extent reflective of the fact that Chinese authorities have put in place a very significant stimulatory package and policies, and the Chinese economy is almost back to where it was pre-COVID. And that's in areas of infrastructure activity, retail sales, manufacturing, fixed asset investment. Equally so, with that big stimulatory package taking place in China, certainly in terms of the infrastructure and construction side, demand on steel is rising dramatically. And so they are increasing production in their steel mills. That's good news for the Australian iron ore producers. And so the chart on the left-hand side shows that steel mill activity in the red line. The reason why we're seeing the iron ore price go up from $85 a tonne in March and April to currently over $120 a tonne is that we are seeing supply constraints coming out of Brazil. And that's clearly good news for Australia. It's not going to last forever, but while COVID is impacting Brazil, the supply disruptions are quite significant. And there's absolutely no doubt that China is very much dependent on our iron ore side. But it's not just iron ore showing us a pickup in activity. So too is the industrial metal copper, the chart on the right-hand side, that light blue line, and the oil price. So once again, we are seeing that commodity prices are giving us some signals of a rebound in industrial production. Now, as I talked about risks in my opening remarks, quite clearly the big risk in the very short term is the US election. Now, this chart basically shows not what the polling is saying, but what the punters are saying. In other words, where is the money going in terms of betting on this election? Now, as you can see, the area that was circled back in February, March was when basically Joe Biden won the Super Tuesday results and became the Democratic nominee. Certainly the punters liked or preferred Biden in the early component of that. When we had the conventions in August, we saw Donald Trump's pick up in terms of the perceptions and the voting got, or the betting, should I say, got a little bit closer. But unfortunately for Donald Trump, the first debate clearly did not have the impact that he thought it might have done. And we've seen the money well and truly go towards Joe Biden. Once again, we can't rely on polling. And obviously, this is just one area of estimations of the winner of the outcome of the election. But if it's close and we do see a contested vote, that's going to cause all sorts of confidence issues, both in the United States and certainly right around the world. So I'm sorry, we just had that slide. Let's go to the next one. Now, I use this slide every time I present, and this is a slide of how global financial markets have been reacting to all of these risks that I've touched on, even the global growth outlook. This is a chart of the VIX index, the volatility index. The VIX is basically listed in the Chicago Board of Trade in the United States. Investors, individuals, business owners can buy the VIX as a hedge or an insurance policy against risk and volatility. As you can see on the right-hand side, the VIX basically rallied very strongly on the back of concerns of the coronavirus impact. The orange line coming up on your screen is the S&P 500. That's the top 500 companies in the US share market. And of course, we saw a 35% decline in that market at the time when coronavirus first hit. But interestingly so, we've seen a significant rebound from those lows. And that's largely driven by a couple of things. Firstly, low interest rates around the world is very positive for growth assets. So growth assets are shares and property. Defensive assets are cash and bonds. And obviously, when you've got low interest rates, cash and bonds aren't providing you with big returns. Also, the share market is a forward-looking indicator. And at this point in time, the share market is certainly forecasting that we're going to see a recovery in 2021-22 by seeing earnings start to pick up. But we are expecting to see volatility start to increase as we get closer to that US election. So something we're watching very, very closely. Just a couple of quick more slides and I'll finish up. Macquarie is not the only one looking at or forecasting a V-shaped recovery, although we're probably the most positive in terms of the rate and pace of that recovery. But there's absolutely no doubt the Reserve Bank, Australian Treasury, and even a survey of key economists around the world by Bloomberg are forecasting a rebound through 2021 and 22. And our view on interest rates is very much predicated here in Australia on really what the Reserve Bank focuses in on, which is inflation. And inflation, a big component of inflation, is driven by wages growth. So no wonder the Australian government reacted very, very quickly with JobKeeper to make sure there was enough money for households to spend, even just on consumer staples and survival. But even more so, the recent round of the budget would be certainly suggesting they were having a greater focus on creating new jobs and basically wanting to see salaries and wages start to pick up. Wages growth started to decline at the end of the mining investment boom in 2014. That's basically had inflation under the range by which the Reserve Bank wants to manage inflation. That's that 2 to 3%, that grey bar you can see on that chart. While inflation is under that bar, it's likely the Reserve Bank is going to keep rates on hold. We don't think the Reserve Bank will justify cutting rates again, but we certainly think they can add other policies, particularly around access to credit. So they're going to make sure the banking system is very robust and there's plenty of funding to the banks in regards to their ability to lend. Equally so, the correlation between household disposable income and property prices is very, very clear. What we are seeing, quite interestingly enough, is as a result of the policies that have taken place, sentiment is turning on property, particularly around an increase in the number of sales and listings. But I think the most important thing is surveys showing that those who surveyed do think it's a right time to buy property in the Australian property market. This is also reinforced by the REA.com index on buyer demand, and this shows the online interactions. Now, obviously, quite a bit of the early stage of these online interactions were people who were stuck at home searching the property markets and not necessarily genuine buyers. But it has started to stabilise, except for Victoria, for obvious reasons, and that would certainly suggest that there is some buyer interest into the Australian property market, and for good reason. to some extent when we see servicing costs are very, very low. The lowest have been for a number of decades. The actual mortgage rate is the lowest for several decades. And certainly we are seeing the housing affordability improve, particularly in those mining states. Perth, Adelaide, Brisbane to a lesser extent are now far more affordable. And in fact, vacancy rates, particularly in the high density sector, has in fact started to go down. So we are seeing a shift of money towards those areas. This is my last slide. I'll quickly finish up on this. And this is a very quick summary, obviously, of the budget that we saw. Quite clearly, the government is basically shifting or substituting JobKeeper into the market, trying to create jobs by cutting personal income tax for those who have got work, providing tax incentives for businesses to invest and to train. Obviously, access to easier credit, not only through what the Reserve Bank is doing, but basically changing to some extent the regulations around lending for the banks. Obviously, more bigger picture in terms of structural reform, looking at clean energy policy and a shift to gas, spending some money, but probably not enough, on upgrading NBN, given the huge amount of increase in volume and traffic online. But good news, they're spending $4.5 billion on an NBN upgrade. And more importantly for businesses, quite clearly a focus on regulation and deregulation, so cutting red tape. And hopefully some changes maybe in IR, where we do see some improvement in the wages side, but along with that, the necessity to keep productivity going. And lastly, although we are seeing some good allocations of funding to the manufacturing sector, giving it such a large sector to our economy, they probably need to refocus on that a lot more. But again, why shouldn't we be developing more resources towards technology, add more value to our food exports, certainly becoming less dependent on China in regards to our medical products. We've clearly got some skill sets there, and also a focus on the defence industry. So clearly there are areas that are very, very important. This slide is for all the lawyers out there. It reminds me to say to you, please take all the information I've provided you this afternoon as general advice. It's not specific to your own goals, needs and objectives in regards to either your wealth or business activities. Quite clearly, Andrew has touched on what Macquarie Bank is doing from a business banking perspective in the insolvency space and other segments. We've spent several $100 million on our digital banking platform. If you're not a customer of Macquarie and you'd like to consider to be so, please go online, have a look at that platform. I think you'll be impressed. And I know I'm going to hand back over to Daniel on this. Let me see if I can do this correctly, Daniel. Shane, my apologies.
That's all right.
Here we go. So I'll stop sharing my screen. And how do I hand back over to you?
If you just go into if you
participants,
click on the participants and then just click on the more, and perhaps hand the host back to Andrew just so he can finish off his stuff. Or actually hand it to me, because I think, Andrew, do you have any slides to?
Yeah, look, I'll just, while you're switching over to the host, I'll just share from a banking perspective what you and your clients should be considering for the next sort of 6 to 12 months in, I guess, dealing with your bank. So the key considerations from our point of view is don't avoid your banker, be really proactive and have early engagement, even if there is, I guess, signs of stress. Banks are far more willing to cooperate when there's proactive engagement. Understand your covenants, so really own that relationship and understand how you're tracking against those covenants. Don't just rely on the bank, because by the time the bank's reaching out to you about those covenants, it's a little bit too late. So that way you can, I guess, proactively reach out to your banker to have covenants either reassessed more favourably or have them waived. Have a really tight understanding of your cash flow. So banks will want to see a really concrete cash flow forecast and not just rely on the P&L and balance sheet anymore. A key tip really is to look out for when facilities are expiring. So if they're coming up in the next 12 months, credit's going to be increasingly harder to obtain. So you don't want to be caught out. So again, early engagement around extending some of those facilities. And lastly, banks really have a heightened sense of anxiety around fraud, particularly businesses that are managing trust accounts. And you as business owners and directors should also have that same, I guess, sense of awareness just around where potential fraud might occur with people within your businesses that are dealing with a trust account. So if you think there's anything we've touched on today that we can help you or your clients, yeah, as Martin said, please feel free to reach out to one of us. Thank you, Shane.
Yep. No, thanks, Martin. Thanks, Andrew. Thanks for those presentations, guys. Greatly appreciated. Next up, we've got Stephen Mitchell from Resicom and Oak, which is now both together as part of a wider business, which I'm sure he will touch on or talk about, or would be happy to talk about if it's not in part of his presentation. And he's going to be going around private loans, low doc loans and stuff that's outside and doesn't fit the normal banking landscape, and where that can fit into, you know, part of this COVID response and trying to recover, thrive and survive in this environment. So I'll now hand it over to you. Thanks, Stephen.
Thanks very much, Shane. Thank you everyone for joining us today. So just to introduce myself, Stephen Mitchell of Oak Capital. So that we did hit market yesterday with a little bit of announcement that we've been working on for a while, which was essentially taking out the full ownership and control of Oak Capital as a group. I have another business which has been around for 15 years in Resicom, and that entity now will ultimately become a subsidiary of the Oak companies moving forward. So there was some information on the Advisor, which is the mortgage industry magazine as such, and that went out yesterday. So we're very excited by that, and ultimately we're forming the businesses from 2021 really to hit as one brand. We've decided, given the hangover of COVID that's still affecting all of Victoria, we can't exactly go out and have a big party and celebrate it with all of our clients and colleagues. So we're going to sit on that sort of announcement and rebranding as such from next year. But together they are effectively one, but we'll leave some partying for next year when Dan Andrews lets us all out. So let's just to touch on, I guess, a bit about Oak and a bit about Resicom, so people know where we're coming from. Oak Capital is essentially a funds manager and a mortgage fund provider. So we have two mortgage funds. We're a private lender ultimately, if you look at our history. So in saying that, we look at assets, real estate assets anywhere across Australia to lend on, and we lend, you know, generally 65% LVRs on property or below. We do first mortgage lending and we do some second mortgage lending as well. And one of the keys with being that type of lender is we can apply common sense lending to everything that we do. We have two funds, so we deal with retail investors from an investor perspective, and we deal with wholesale investors as well. We have offices in Melbourne, in Collins Street, and also we have an office in Queensland, and the fund's been operating since 2013, so we have a bit of history there. Generally, from an investor perspective, they return 6, 7, up to sort of 10% per annum on their money, and they get to choose their mortgage investments that they like to invest in. So we don't run a pool of money. Every loan that we lend is actually matched with an investor or a group of investors. So from an investor perspective, they know exactly what the asset is that they're secured by. From a lending point of view, generally 12-month loans. So we are a relatively short-term, get in, get out, go over and see Andrew at Macquarie once you've solved your problems. We're not there to hold you for 30 years. We do look nationally and we look at all asset classes, providing it is real estate. So we'll do resi, industrial, commercial, any vacant land. We'll consider everything and then lend proportionately against that. From a scenario point of view, so people have a bit of an idea what that looks like. We might have a client that is going to end up at Dyanco. They've got a wind-up order and they need to pay the tax man $500,000 on, call it Monday. But they've got an unencumbered house because they've done very well at not paying their tax and paying off their mortgage. So we will come in, lend them $500,000 in 3 days. They clear out the tax man, and then they can spend the next 6-12 months sorting out their financials and everything else they need to in order to jump back to the next tier of lending. So they'd pay obviously a price well above the banks to get that sort of transaction done, but it might only be in the high single digits, but it allows them to get out of that impending problem because they have equity. So if they've got equity, then there's generally an option. It's going to come at a price point, but ultimately doing that is far better than going necessarily through a wind-up. It could also have a developer that has 5 units at lockup. He's overspent. The bank's not willing to put any more money in, and they need 300 or 400 grand to finish those sites off. So we were looking at coming in on a second mortgage position, fund that extra 300 or 400 grand. They finish their units, then again, they refinance and away they go. So everything we do should come and go relatively quickly. We do have some cheaper products where they can sit a bit longer, but generally it's a 12-month type transaction. From a Resicom point of view, similar type of market. So we've always been second tier. We've been around 15 years and we're known as a mortgage manager. So ultimately, we don't control the capital. We have other funding lines that we access and we essentially rebrand their money and then sell it out to market through the mortgage broker space. So brokers come to us, again, when they can't necessarily place that deal or they've gone to a bank, found out the client has a couple of defaults and now they're a bit stuck. So they come to us, say, where do I go? We then place that loan with a second tier. It could be a Latrobe Financial, a RedZ or a Pepper, and get that deal placed for them, therefore providing the solution to the client. And from a broker perspective, looking at Resicom and now Oak, I guess the sell is, yes, they can potentially go direct to some of our funders in the mortgage management space, but they need to know all the details about how to do those deals. And a lot of brokers in the market deal in bank world. You know, they write 90% of the time they're writing bank home loans. So when they get a deal that doesn't quite fit, we're there to help them. And we've got the time and energy to hold their hand to get the deal done. So they'll apply to us and say, what do I do? And we'll say, okay, the best option for the client is product C, but we're going to need this. And then we get that done, get the deal through, and then they can hopefully move that client out 12, 24, 36 months later, back to a cheaper product via a bank. So everything we do, as you can probably tell now, is not bank world. So no one's to call us asking for the 3% interest rate. That's not our world. We're all about providing a solution to the client, okay, and doing that based on their criteria and the speed that they need us to meet that at.
So Stephen, we've got a question that's just popped in.
Got a deal.
Do you look at the agri land space?
Oh, good deal. So generally, we are, resi commercial, we do small land, we do some DA land. Large agricultural land is very difficult for us to fund. Having said that, if they've got, a 1,000 acre site with a lot of equity and they only need 200 grand to pay out a creditor, we might get involved. But if we're funding $5 million on a farm, we're not going to be able to raise it. So it does come down to the ability to raise the amount of capital. So we do get some where it's a smaller dollar size loan and they just need it and the asset is a rural type asset. We can absolutely look at that. And one of the big benefits we have in our fund, we have the ability with one of our funding lines that we don't need to get an external valuation done. We have an internal team. And therefore, if you were to go get an agri loan done, even if they only needed a couple of $100 grand, the valuation itself could be quite cost prohibitive. It may be, $5,000, $10,000. If we can get comfortable about that number internally with our property specialists, there is no upfront costs. We can tell them what we think it's worth. If the numbers work, we'll do the deal. Exit strategy changes the other thing. If they say, look, it is an agri deal, but they only need 300, 400 grand, but here's their exit in a month, then again, it helps sell the deal. We've got to know a fair bit more. As a rule, we don't go buying rural type transactions, but we are always open to look at anything. Thank you very much.
Fantastic.
So just to finalise on, I guess, the merge. So from a combined point of view, we have approximately 700 million of assets under management of all the mortgages we manage. We have a target of $1 billion by 2022. And yeah, the goal is to be that sort of one-stop shop for everything second tier. So to touch on, I guess, market, what we've seen, obviously the hardship claims that have been going on in the market have been enormous. The numbers from the banks are approximately 270 billion of loans that went on to hardship and moratoriums and not paying. Obviously that's going to have a large effect moving into 2021, and we're big believers that 2021 is when everything's going to start to really wash through. At the moment, people don't need to necessarily pay their mortgage, or things are starting to change now that end of September's come and gone. Even the second tier lenders, we get reports of some that are saying 8% of their book, 23% of their book from another has been on hardship claims. These are enormous numbers that have to have an effect. This interest never went away. It's just been tacked onto the loan and needs to be caught up at some point. One of the statements from a chief risk officer we know is that they're saying, of those claims, generally a quarter or a third, they think can pay, they're just not paying. Another third will get there, but there'll be some struggles. And another third will be a major problem. So we do expect there's going to be some mortgage defaults numbers that are going to start going up through 2021. And those loans will be managed slowly out of these lenders. but it's going to be very, very interesting lending landscape in 21. And we just haven't seen any of that yet. Landlords don't need to be paid. ATO isn't getting paid. Creditors in general aren't getting paid. And look, we've seen that on our loan side. We went quite quiet from loan inquiries for sort of, immediately really from April onward. It started to bubble a bit when we saw signs of life, but then we got locked down again. So everything sort of went pretty slow. And normally we see that distressed market. But if people aren't getting told they have to pay the ATO and they don't have to pay their mortgage because they can just get it put on hold, then they don't need to really come see us. And no one's generally acquiring businesses, buying extra assets. Everything's just on pause. So we're going to see a lot of that come through in 2021. Look, the lending opportunities that we've seen, for the second tier market, again, are starting to bubble. Our inquiry levels doubled in the last 2 weeks. I think there's certain businesses now saying, you know what, we've just got to start doing stuff. They cannot keep waiting. And the realization that you're ultimately tacking on to the end of whatever your debt is starting to sink in. So people are starting to deal with that. The other catch for us as a lender and for clients and accountants out there, we're seeing a lot of startup private lenders. So there's a lot of chase to the bottom on yield lenders coming out. We've got bankers that might leave their job and they got a high net worth client who's sitting on $10 million not getting a yield. So they become a lender. The risk with that, of course, they're lending high LVRs at low rates. No one's following the old rate for risk model. And we think that, again, that's going to be a problem next year. We believe there will be a cooling in the market in some shape or form, and they may get caught. So we are a bit concerned for some investors that aren't lending through a sophisticated structure and are just seeing the return and going with it. There's a lot more to lending than just getting it out the door. You've got to be able to get it back, which is the other big key. So we've been quite cautious ever since February. We pulled back on our second mortgage lending, and we're only now starting to open up a little bit there. And initially we saw also the second tier lenders drop dramatically out of that market, especially in development space as well, which has left a vacuum for a lot of these loans to get filled by potentially unsophisticated lenders, which is, is going to play out next year when we see that occur. Next year, we also feel that the banks obviously will be extremely tight. As Andrew pointed on, credit will go through a bit of a crunch, I think. We've seen that already with the government funding that they've given to banks and other lenders to lend to business borrowers. In discussions with many prime mortgage brokers we know, not many have ever seen a loan go through. So we're not sure who's actually getting this money. But the banks have strictly had, I think the offer got made by the government, and then the bankers got a call saying, beware, if you start lending irresponsibly, we're going to come after you. So you've got this money to lend, but be very, very careful. The problem is the people that need the money can't show they can afford the loan right now. So it's kind of a double-edged sword. So, there's a lot of these ideas that sound good and that they look good on the ads and on TV, but in reality, if you're a small punter businessman, you're struggling to get money. You go to your bank and say, look, my revenue's dropped, but I need one of those business loans. They go, well, you can't responsibly lend to you. So we're going to see a lot of that come through. And if the clients don't have equity in assets, it's going to be a problem. And I think it's going to be, definitely from an insolvency point of view, there's going to be a lot happening. It's just whether or not there's any assets there to get from. In regard to property, from what we've seen, resi, remarkably good, has been remarkably good, even in Victoria. Having said that, you can't repossess a property if you try. So, we haven't seen any of that side of it. There hasn't been that forced side of selling. People are only moving or buying if they are structured to do so. So 2021 will have that play out. Commercial, though, definitely seen problems. We've had an asset outside of Sydney that was 11 million early 2019 and sold for 7. So that is a drop. On the phone call just prior to a large valuation firm I know, they're talking 50% reductions on retail assets already. So these assets, especially CBD, obviously, CBD assets and that are getting quite concerning, and that will then flow over to their ability to access capital. So I don't have a crystal ball as to how it's going to play out. I just don't necessarily believe in the beautiful picture that's going to all occur next year and everyone's going to get back to it. There's going to be a hangover from this. And that means that clients need to keep their eyes open to what the options are. If they cannot get through, then they need to look at certain options. If they can get through, but they need some funding, they need to know what's out there. And it isn't just banks. The banks will tighten up dramatically. The second tier lenders will absorb the old bank deals that the banks wanted. But therefore, there's going to be that gap of what falls out from the second tiers. And that's where groups like ourselves will be there to catch as much as we can. But the deal has to make sense. And the clients need to know that if they are coming in for a short period, they need to have their exit strategy well and truly tied up. We don't provide solutions for them to be there for the next 5, 10 years. And generally that they won't last if they have to pay those higher rates. You know, businesses need to have a plan to get back. So it's really important for accountants and solicitors and any sort of advisors to know there are other options, but they need to make sense for that client. And for some clients, they are just better off saying, you know what, it doesn't work now, and to get out, rather than go through the model of just equity stripping ultimately by paying every single man and his dog another fee to get to the same position. So people are going to need to have long, hard looks, I think, at themselves. And it sounds very difficult, but I think we're going in for a difficult market. I guess in sort of closing where we can assist, I touched on our products, but in summary, you know, first mortgages from sort of 7.5%. I think a lot of people have this idea that private lending is scary. Second tier lenders are scary and the pricing is huge. Definitely a lot of accountants have that view. At 7.5% for a deal you can get within a week, it's not overly scary, right? It was what the market was paying only a matter of years ago for a home loan. The key is for us, there's no upfront fees. The deals are real. You know, be mindful of lenders offering huge LVRs, really low rates, but a $20,000 upfront fee. There's a reason they're charging $20,000 up front, because they're never going to fund the deal. So you've got to be dealing with someone who's reputable. We only issue offers that we want to actually fund and settle. We do second mortgages as well. They're obviously at a price point above. We'll do bridging loans. We can capitalize interest. So clients that are affected, if they've got a hospitality restaurant, we've seen one just now in Hawthorn, they are, you know, they're taking the gamble ultimately that the restrictions are going to release and they can get back to their restaurant running, but they want to borrow 6 months worth of interest on their loan. They have to leave the bank because the banks have given them the tap on the shoulder to move, and this is starting to happen now. We've seen it. So we'll fund them in. They'll borrow 6 months worth of interest. You know, there is a bit of crossing their fingers that in 6 months, trading's okay, they get their numbers up and they move back out. But it's either that or the bank sells them or they have to sell now. So it's a clear deal that makes sense for us from an asset position, and also for them. It's a good solution for them to get in and out. Incomplete build sites, as I've said before, residual stock. We're going to have developers holding a lot of assets they finished. Now, if they're not fully leased, if the developer doesn't have financial data strong enough, they might struggle to get those assets held at the bank whilst they try and orderly sell down, especially in a market that may have a slowdown in property. So we can consider lending on the whole group of assets if they've got 10 or 20 units, obviously at the right LVR, and then they can sell down, piecemeal that asset and pay down the loan. So we can put a structure in play that works for them so they can sell them off one by one without getting stung. Non-resident loans, you know, we look at all those sorts of things. Ultimately, it comes down to the asset and then everything else from there. So look, we're here to assist, and we're here to help rehabilitate some clients and also just provide opportunities to settle a purchase that they got stuck with and need money in 4 days. The key is the equity and the exit, and tell us openly and honestly the whole story, and then we can come back to them with the best product that we can provide. But look, I wish everyone in business good luck over the next 12 months. It's going to be an interesting ride, but I think knowing each other and knowing the right places to go, we can all help steer our clients to a better outcome.
Fantastic. Thank you very much for that, Stephen. Very informative. Now, there's a couple of questions in the Q&A box, but I might get you, if you want to perhaps answer them online, typing in. We'll move.
Sure.
I think you've covered off on a few of them in your closing anyway, so, but you want to do that. And we'll move on to Tony Eldred, who hospitality extraordinaire and director of Eldred Hospitality, also a director and shareholder of the San Telmo Group of Restaurants. He's going to talk specifically about the hospitality industry now, and we'll get Tony off mute, and I will bring up the presentation.
I'll just introduce myself first, if you don't mind.
Absolutely.
I've had that brief introduction, but I've been in the hospitality industry in Melbourne now for 50 years, and I've owned this company for the last 30 years. And we specialise in turning small businesses into properly structured companies, or setting up businesses to operate in multiple locations. So we would deal with probably a couple of hundred businesses a year in consulting, and about 1,500 students through short courses at our train college. And the reason I'm saying that is it gives us a pretty good understanding of what's going on in the industry across the board, apart from the fact that we operate our own restaurants. So Shane, if you want to hit it.
Absolutely. Let's make sure this works.
Okay, I'm entitling this a bad year for optimists, because that's what it seems to be right across the hospitality industry. And it's a peculiar industry that has some major challenges for recovery. So what I'm going to do is explain to you what we're seeing at the moment and what we think may help or assist, and where you may be able to help us. Next slide, please, Shane. Okay, now you're pretty aware of the government restrictions that are going on now, but I need to expand a little bit. In March, they really closed down the hospitality industry, and that required a huge expense in itself. There was the disposal of a huge amount of stock, usually at fire sale prices, etc. And the whole place had to be really closed down, and the staff had to be dealt with. And that's probably a little bit more complex than what you might realise. Just in the restaurants we operate, we had 35 foreign visa holders working for us who were left with no government support and no way to get home. So the government restrictions really have added to our costs in we've had to support these people, feed them, get them couch surfing all over Melbourne. So the restrictions have not only affected the public and the businesses themselves, but a huge number of other people. Now, when the government relaxed restrictions a little while back and started to allow people into restaurants, that was a double-edged sword, because the number of people they allowed into restaurants really meant that restaurants operated below break even. Only a few of the restaurants I deal with were able to actually make more than their costs during that period. And yet they wanted to operate in good faith, because they knew that people wanted to still use restaurants, etc. Now they got shut down again. So they've had to dispose of all their staff, etc. Now we don't know what's going to happen in the future, but we do know that all of the medical people are suggesting that particularly restaurants, bars and nightclubs are one of the worst places for potential contamination from COVID. So in worst case scenario, this could go on for quite a while with the hospitality industry. Next point, please, Shane. Now we've lost one of our major drivers in the industry, which is tourists. The average international tourist who comes to Australia leaves an average somewhere between $10,000 and $15,000, of which about 50% of that is left in hospitality businesses, hotels, restaurants, etc. So there's a major driver, and looking at it from the opposite direction, a lot of the tourists come here, particularly to Melbourne, because of the food culture, etc. here. So in other words, one drives the other. Our economy is driven by the tourists coming in, and the tourists drive our economy. Foreign students who are fairly thin on the ground at the moment, we're a major class of customer for the takeaway food in the lower down levels of the hospitality industry. So the loss of both the premium consumers and the down market consumers has really created quite a bit of havoc. And we don't see tourism really coming good in Melbourne for a while. We think it'll be quite a while before foreign people are allowed in, and I think that the regional people are going to be very wary of coming to Melbourne for a while. That seems to be their attitude. And the other thing is, with all the offices, etc., that are vacant in the city, we don't have the CBD trade that was the greatest concentration. There were 5,800 restaurants within 15 kilometres of the CBD in Melbourne. We think there's going to be a lot less, and I'll come back to that issue later. Next one, Shane. Now, the big ogre here is accrued debt, particularly rent. Now, when you think about the situation, if the government shuts your business down and then the government publishes a formula for rent, and that formula says that we'll take how much your income is reduced and we'll work out a payment scheme where you pay half now and half later. A lot of the places have had really no income whatsoever, and yet under the government formula, they're required to pay 50% rent over a period of time, which means that when they reopen, they'll be saddled with 150% of their normal rent until they clear the debt. There haven't been any, using a legal term, there's no force majeure clauses or whatever in the commercial leases that they have. And the attitude of a lot of the industry at the moment is, if I've been forced to close down and I am unable to operate because of forces outside my control, why should I have to pay rent because the property is not fit for purpose? So particularly the legal people out there might pay attention to this one. We think there's going to be a lot of activity on people going to VCAT or whatever and arguing about the situation, because otherwise they're going to really be forced to close the doors when they don't have to. Next point, Shane. Now, the loss of staff, a lot of staff didn't get the government support, a lot of the young ones, etc., a lot of the casuals. A lot of staff failed to make the sort of money that they needed or they were used to. A lot have resigned. We think as soon as Australia opens up, there's going to be a mass exodus of all of the visa people who are on working holidays over here back to their own countries. And there's going to be a huge lack of bottom level, particularly casual staff. Now, the problem that the restaurants face is that at a time when they're forced to run with reduced numbers and reduced income, to recruit and train a staff member properly in a restaurant or whatever is going to cost somewhere between $3,000 and $5,000 over the first 3 months. And if you had to replace 20 or 30 of those, that's adding a huge burden onto what you're already trying to do. So there's going to be a scramble for staff, and a lot of staff have been, put off by this whole situation and are determined not to come back into the hospitality industry. Next point, Shane. Now, the other problem is that the supply chains are in absolute turmoil. We think a large number of suppliers are going to go out backwards, are not going to be available. We know that the ones who are still trading are carrying huge debt that didn't get paid when this hit, and they're going to have trouble. This is some of the accrued debt that the restaurants owed. So supply chains are going to be quite topsy-turvy for a while. And we don't really know what's going to happen with that, but it's creating some problems already. Next one, Shane. Now, the public have been educated during COVID to do two things. They've been educated to cook at home, and a lot of people have found a newfound interest in cooking. And they've also discovered online ordering. Now, the online situation is going to drive the creation of a load of what we call dark kitchens. And if you don't know what a dark kitchen is a remote location from a normal restaurant site in a cheap, perhaps industrial area where the rental is quite low, where they can produce and do home delivery from there without the severe overhead of a retail rental in a CBD or something. So we're going to find that perhaps a lot of the industry, or not a lot, but a number of the restaurateurs are possibly going to close down their normal restaurants and operate home delivery, etc., purely out of dark kitchens, because they've discovered that it's a lot easier than running a restaurant and it's profitable. So we're finding that the industry is likely to change quite a bit. Next one, Shane. Now, restocking and reopening is the purchase of stock. Typical restaurant, probably $20,000 or $30,000 up front to restock. And then they've got to do a deep clean, which is also very expensive and has to be done by specialist cleaning companies. And they're going to have to come up with the money to do this at a time when they haven't got any money, especially the smaller ones. to paint a proper picture here, most of the small hospitality businesses around Melbourne were not making much profit before any of this happened. The average profit out of a restaurant was somewhere between 5 and 11%, which is not particularly brilliant. A lot were making a lot less than that. But the notable thing was most of the businesses had no safety money. They didn't have an accrued bank account or whatever for a rainy day. They were running pretty well hand to mouth. And then all of a sudden this happened and there isn't a lot in reserve. So the cost of reopening is going to be something that a lot of them can't afford, particularly on top of the fact that the government support is going to be wound back and they're really going to be left with not a lot of money at all. Next one, Shane. Now, the crystal ball. We estimate that as a result of all this, about 30% of Melbourne hospitality businesses will either not reopen or will not survive next year. We're already seeing the trend across the place. On the other side of this, before COVID started, we also believed that Melbourne was 30% oversubscribed with restaurants and cafes because the industry's been driven for many years now by both property developers who put restaurant and cafe spaces in every building they build, and the media, which has been driving the industry with shows like MasterChef and My Kitchen Rules, etc. So we built to the point where we were really oversubscribed. The competition was so fierce, nobody could put up their prices to where they really needed to. And we think as a result of this economy suddenly taking a downturn that we're going to lose about 30% of them and over about a 12-month period. Next one, Shane. Regionally, we think it's going to be about 20% of hospitality businesses. They're affected severely by tourism. Tourism has declined quite substantially. So I think there's going to be a fair bit of carnage. Next one, Shane. Now, it's the smaller businesses that are going to suffer the most. There's an awful lot of small businesses which are just family businesses, mom and pop businesses or whatever. They've got no real support behind them. And we think that they're not going to be able to sail their way through all this. So there's going to be a lot of misery. Next one, Shane. We're already seeing some of the larger groups. One of the things that we see in the hospitality industry is that hospitality businesses agglomerate in order to reduce their overhead costs. They operate combined marketing and, combined production kitchens, all that sort of thing to reduce their overheads. But they tend to grow beyond their infrastructure, particularly human infrastructure, and a lot of them are on the knife edge at the best of times. And we know that a couple of the high profile operators are busily trying to sell very expensive holiday houses, etc., which tells us that some of the larger groups have got pretty wonky at the moment. Next one, Shane. Now, the initiatives that we would like to see, some of them are unlikely, but I was in the industry in 1983 when the government removed tax deductibility for restaurant entertainment for businesses as a marketing cost. It was wonderful. It was the land of the long lunch. Over the 18 months after they removed the tax deductibility, we lost a third of all the restaurants in Australia. So my colleagues and I out there in the industry said, well, if we lost a third, then maybe the government can give us a boost by putting it back, because we feel that this would please both businesses who could go back to using restaurants for marketing entertainment and the hospitality operators themselves. It might not do much for the taxation department. So that's the big one that everyone's pushing for at the moment in the industry. Next one, Shane. The award structure in hospitality is a nightmare. There's about 62 different awards that apply to the hospitality industry. Now, I got my staff a couple of years ago listing all the government departments that have anything to do with this and ringing them and asking them what are the awards that apply to this, this and this. Now, we got totally different answers from every government department that we spoke to. No one seems to know what's going on. And the restaurateurs are saying, well, we can't double our prices on a Sunday, but we have to double our labour costs. And at a time when the industry is really sick, that's killing the industry. And there's a huge push in the industry to say, look, we need some form of flat rate payment system across the industry. Otherwise, carnage. Next one, Shane. Penalty rates. Created by the award structure, but the penalty rates are quite vicious in hospitality. And the thing is, you think about a business that does most of its trade on a Friday, Saturday, Sunday. So 2 of your prime days of the week, when you're going to do probably 45% of your trade, your labour costs are at least 50% per hour higher than they normally would be. So this is killing the industry as well. Next one. The removal of the government support is terrifying the hospitality industry at the moment. The winding down of it, because we're still shut down, and we're shut down, and they're winding back the JobKeeper support. So we don't think hospitality is going to come out of this for quite a while, and certainly we're forecasting that there's not going to be much happening before February or March, when really the whole government support is removed in total, or at least they're intending to do so. So that's going to mean that what is largely propping up the industry at the moment is going to be disappearing at a time when they're still not trading properly. Next one. This one I put in for my own benefit, is that if you're dealing with hospitality businesses, be kind. They're going to need help, and I know you're not a charity. We're not a charity either, but we're aware that you're going to get people coming to you that are in danger of losing everything or whatever, and they're not going to be very well healed. And I know it's just a sad fact of life, but we're anticipating an avalanche of them. So if you're looking for business opportunities, let's talk about something positive at this stage. There's going to be a lot of move in hospitality real estate. There's going to be a lot of businesses for sale, and unfortunately, probably not many buyers around to buy them, etc. But there'll be a fair bit of conveyancing. There'll be a fair bit of insolvency work. There'll be a fair bit of battling with real estate agents. So from the professional services sector, the law sector and accounting, etc., there will be a fair bit of business. So that's pretty much it. The hospitality industry has had better days. Thank you.
Thanks, Tony. Thanks very much. Yeah, and one of the industries probably doing it the toughest at the moment in the hospitality industry. It's a good insight for someone that's very experienced in that sector. One of the things that they're going to be dealing with, amongst many other businesses, is having to deal with their taxation debt, which luckily leads me beautifully into introducing our next panelist, which is Olga Koski from Taxassure, who is the leading person in regards to getting tax debt negotiation with the ATO. So without any further ado, I'll introduce Olga.
Thanks, Shane. I'm Olga from Taxassure. What we do sounds very simple. It's a basic proposition. We help people with their tax debt in a commercial and sustainable way. Anybody that has tax debt of any size, we can help you, whether they're individuals, sole traders, partners, family businesses, small corporations, large corporations, you name it. We can probably start the slides if that works for you, Shane.
It does.
While I'm talking. What I'm hoping to convey today is, yes, there are ways, but I don't know whether people talk about tax debt and positive in the same sentence, but there are ways and things you can absolutely do now to help your business, to help your clients' businesses to come out on the other side, and there will be eventually another side of this in a positive and a sustainable way. If we just flick to the first slide around the different things that we do. Thanks. There's a number of different ways we help our clients with tax debt, and this includes reduction of the debt and also managing the debt in whatever way is going to work best for every individual client. It's not a one-size-fits-all at all. Every business has their own individual needs, especially at the moment. So it can be a mixture of one or all of a reduction of debt, managing the debt, which can be payment plans, whether they're long-term, whether they're short-term. It can also look at finance, business structure, debt management options. What we want to do is we want to look after the debt for you, and so you can get on with running your business and that the clients can get along with running their business. We deal with a different area of the ATO than accountants would otherwise deal with. So we deal with the lovely debt area, and we've actually over the years have got some fantastic relationships with the directors and with the staff in that debt area, which allows us to get the different results that we're able to get for clients as well. Our team is a mixture of lawyers, which have all been business owners as well, and also client service specialists that help our clients in all of the different ways. If we can just flick to the next slide, please, Shane. What I thought I'd do is go through briefly what the ATO's attitude is at the moment. And exactly as what Andrew was saying before, is proactive engagement is the absolute key, as it always was, but even more now. So we've seen a real shift in the ATO through the pandemic process on how they've both dealt with it internally and how they've dealt with businesses and individuals that have had ATO debt moving through the pandemic. In the middle, I think everyone would understand and everyone would agree there were large holds and they were given quite freely and quite easily. A very specific line was drawn in the sand on the 14th of September. We were advised by a number of different ATO officers, and it was also published that as at that particular date, which is the 14th of September, the ATO are now back in active collection mode. Now, there's a number of different things that means and what they're doing now, and that relates to where your company or where your client's company sits in how the ATO considers their debt. So as we've got on the screen, there's three main areas. So we've got companies that their debt is relatively new, often exactly what we were just hearing. The hospitality industry is absolutely one of them, and different industries that have been specifically hit and have incurred debt recently because of COVID. The second situation we've got is a number of companies, which I'm sure you've all come across, that have got historic debt, and that this debt was incurred prior to COVID, and they've had for a number of different years. And then the third one is super. So I'll go through how the ATO briefly are looking at these different areas, and then what we'll do is look at some proactive approaches on the next slide that we're able to take with these different areas. So companies that we're calling it have got effectively new debt, but generally have a good compliance history. The ATO are now still back in that active collection mode. So one of the most important things is the engagement. What most of you will all already know is the ATO is extremely bureaucratic. So you either fit in a compliant basket or a non-compliant basket. And there's a number of ways to stay in the compliant basket to ensure that the active collection doesn't end up in debt recovery action. And also what can be done for those sorts of businesses to get them on the right foot moving forward. So as long as they stay in the compliance space and we can go through how that's achieved, then companies that have this new debt can be in a good position to move forward. The ATO's attitude to companies with historic debt is that that debt was incurred prior to COVID. So we're already seeing pushback in relation to needing very detailed applications for further holds, for further deferrals, and with payment plans, it's almost business back to usual. Explain to us why and put all of that information in with a detailed payment plan as to why they should have a payment plan, and not only why the debt has been incurred or increased because of COVID, but we also need to go back and have a look at what the old reason was for the debt. So that's back proactively on its way to being collected by the ATO. The third one is super, and with super there was never really any change. So super is a debt that, as many of you know, goes across personally to a director of a company. And even during COVID, there was a little bit of sympathy in relation to the payments around that, but never forgiveness of any of that sort of payment. But that absolutely is back in collection and enforcement. With the super, about 18 months prior to COVID, I'm sure many of you will have also seen there was a big push for audits and a big push for super compliance. We feel that that's absolutely coming back now, and as we move forward, that's going to ramp up hard and fast again. What I'll do is get you to go to the next slide, Shane. Thank you, which I think is probably one of the most important things now is what can we do right now and moving forward to plan for all the businesses. And there's going to be, yes, there will be some that fall over, but I also believe there's going to be a lot that do come out the other side. And if we can help them now and we can plan and all work together now to get the best possible outcomes, then they're going to have the best chance for recovery and survival on the other side. There's a number of different ways to do this and a number of different ways that we've been doing and will continue doing. One of the things that is making a massive difference for a lot of the businesses that we're helping is looking at a refund, which is a reduction of the debt that relates to the interest and penalty components. If anyone has been a day late effectively on paying their tax obligations, there will be interest and penalties that will have accrued. Now, what we can do is go all the way back for however long that may need to have a look at whatever interest and penalties have accrued on a client's file and do a remission application. So those interest and penalties get refunded and the total amount of the debt, the result is reduced. We've done some recently that have gone back as far as 20 years to help clients get all of that interest and penalties back. I'll just give you one very quick example of that. Even if the current ATO position is effectively up to date, we had an insurance company and a security company that had a current ATO debt of $20,000. However, over the last 8 years, they'd actually incurred $80,000 in interest and penalties. A lot of that had already been paid during on and off compliance. We looked at the history of the matter. We also look at all of the legal practice directions that the ATO require for these sorts of applications. It's really important with those applications that you get it right, as you would all know, the first time, because if it's not achieved the first time, and it's a knockback in relation to that remission, then it has to be appealed to a court. So it's really important to get it exactly right and cover off on all the legal requirements that the ATO are asking for in any of those applications. They don't remit interest, 100% of the interest and penalties as a matter of course. These applications are normally around 12 pages long, the way we put them together. In this particular case, we were successful. We got the full amount of the $80,000 remitted. What that did was it cancelled out the client's $20,000 current liability and then also gave them a refund that they could either pull back out or a credit in relation to upcoming tax, which for so many clients at the moment is huge. We often get referrals from accountants, even just around that particular piece to reduce the overall debt because they are concerned and want to make sure they get it right for themselves as well as getting it right for their clients as well as with that. The second thing that we also do and that we're doing at the moment, and even with the active engagement that is now starting, it's also really important for clients to look at what their position, the debt position with the ATO is, and come up with a managed plan and also a structured plan. So I'm going to go through 2 and 3 on the slide together. The managed plan is looking at what the ATO will consider, what their policies are, using the relationships that we've built and understanding what they need to see in the bureaucratic way for them to be okay and to get a payment plan across the line. Now, it's absolutely not one size fits all. It has to be what's going to be best for the clients. Now, in the current climate, this might be a 3 or 6 month structured process about what needs to come together to get the best payment plans and to get the best planning around that. And the payment plans have to be sustainable for the client as well. So we're getting the best possible position for the client, but also keeping the ATO on the side so clients remain in that compliance space and in the good box, the good side of the ATO as well. And sometimes that can be a mixture, whether it's short-term plans, long-term plans, deferrals, reduction of debt, putting that whole strategy and the plan together, then making the application so that at the end of the day, the client can continue on with their business. Their payment plans are sustainable so they can actually manage them so they can achieve them and then they can continue on with running their business. That's my summary, Shane. I've kept it nice and short and sweet. I think Shane's coming back to unscreen share. If we
Fantastic.
just to the next.
Fantastic. Thanks for that, Olga.
What we always say is if you've got any questions, lots of people, I had a question yesterday saying they had a client with $9,000 of interest and penalties. Is that too small for us to look at? We always say, give us a call, chat through it. We want to help clients get through to the other side of this. This tax debt is all we do. This is what we look after. This is how we work. And with both the relationships that we have with the ATO and the understanding of the legal requirements behind these applications, it can really help clients in the current climate with some positive engagement, keeping them on the right side effectively of the ATO, and in the best case scenario, getting them a refund or a reduction of their debt as well.
Oh, brilliant. All right, so now, thank you very much for that, Olga. That was, again, very informative. And I'm tipping there's going to be a lot of work in around that space with, a lot of people deferring their tax, kicking it down the road, and they're going to need some greater assistance when they come out of it, when their revenues aren't at the level that they previously were, and they're going to have to manage those old tax debts too effectively, so they can avoid ending up with myself or Nick.
Yeah, and even if they do, as you're aware, eventually end up with yourself or Nick, there's often work that flows through with directors receiving DPNs. So even if it is at the stage of a DPN or a wind-up, we're still, depending on the client's specific situation, able to go in and help that client get rid of the DPN, deal with the tax debt from a personal basis. And there also are occasions as well with the right funding from even Stephen or Arthur that we can stop the wind-ups as well.
Yep, brilliant. All right, thank you very much for that, Olga. There is I think a question in the chat. If you want to go and answer that, Olga, in the chat, and we'll move on with Arthur just so we keep it flowing. So we'll now move over to Arthur Athanasopoulos, who I now pronounce it correctly as opposed to buggering it up the first time, so stumbling over it. So I apologise again for that, Arthur. We'll also get you on Spotlight video so you can do your presentation. Arthur is another level of finance, a different level of finance to the ones that we've heard of already. He's state manager for pretty much everywhere in Australia except for maybe 1 or 2 states, running the show for Cashflow Finance and the Classic Funding Group. Welcome, Arthur, and I'll let you talk about how you come into the picture, helping businesses navigate their way through this COVID impacted environment.
Absolutely. Thanks for the introduction there. And yeah, as you said, Arthur from Cashflow Finance, thanks for joining us today. From our perspective, I guess we want to just add that extra layer of opportunity to businesses that might have that need as we emerge out of the current environment. And I guess what I'd like to cover quickly today, I think we've touched on a number of these things, but obviously the current environment and everything that's happening there, and I guess how we might be able to support your clients now and into the future using one of our products and what we can actually offer into the mix, and how that works. We might talk a bit quickly about the customer spotlight and what is our appetite, and I guess even the industry for that matter, and some quick tips on pitching what we can offer to clients, because we understand that quite often it's difficult for everyone to understand how this all works. So, and then again, looking ahead. So, just the next slide, if you like, Shane. So, there we go. So I guess some of the key things that we're talking about is, the elements that we see going through and the challenges that SME businesses are going to face. They're going to have to work on their survival and what they need to do. As we know, there's a number of business, the zombie businesses that we've heard about, and we've got a number that are thriving. How are they going to become sustainable and go on beyond the stimulus? And is the stimulus enough? The other question is, once that happens, we all know that one of the biggest and most important things for businesses is for access to capital, and where's that going to come from? And I guess that's where businesses like ours and also Stevens, where we're able to inject some of that much needed capital into businesses going forward. The other thing that's been touched on already today is keeping up with legislation and all the changes and all that touched on the tax issues that are going to arise moving forward. And last but not least, I think it's also important that we've got to remain optimistic and be resilient. So next slide, thanks, Shane. I guess the focus for different SMEs is going to be different depending on the sectors that they're actually in. Obviously, we heard a lot about retail earlier from Tony, and as well as hospitality and tourism and where they're at. But obviously, there's a lot going on in the education, mining, and manufacturing. How are we going to manage our customers, and what have our clients and customers got in place? What have your clients got in place in order to be able to adapt quickly? And talking about changes for staff, and I guess we're going to look at a marketplace where you're going to see that the way that people work is going to become a lot more from home. Tony mentioned earlier about restaurants and the restaurateurs moving into industrial places rather than going back to traditional restauranting. And what type of work conditions are we going to all face, and how are they going to manage cost management? One very important thing for all of that to come together and to assist with that is their working capital, and I guess that's where we certainly can offer. And debtor finance, coupled with trade finance, I think even equipment finance can play a big part of that. That's certainly something we've got on offer and very keen to talk about and perhaps put into the mix and give you a bit more appreciation of exactly what that means and how you can leverage some of the working capital assets in the business, so that we can help people transition out of the current environment that they're facing and beyond. The next slide, if you like. So what is our appetite? Debtor finance is a product along with that utilises the receivables ledgers in businesses to provide working capital. And I guess trade speaks for itself. We're able to do both domestic and overseas trade, so that's not locked into just being a trade from other countries to bring in goods from overseas. And obviously equipment finance, so you can fund equipment both in the business and also any new purchases that are going to be required for all the infrastructure projects, etc. Our appetite is quite broad, and certainly our sector outside the traditional banking sector is one of which we're able to look at businesses on the merit, on how they're tracking right now, and perhaps what we think is going to happen during this period as they transition through the COVID experience and beyond, that what it may mean for them going forward. So it's all business of all shapes and sizes that can generate an invoice and is waiting for payment, predominantly from a debtor finance perspective, that we rely on that invoice and those outstandings to provide value for a debtor finance product. And we then bolt onto that the trade and where applicable equipment. We're not reliant on the business financial performance necessarily. We've got a range of products we've just introduced into the market. Our early pay product, and that's geared so that we can get right down to just being able to fund on the actual invoice itself. So there's very little scrutiny over the business, very little scrutiny on how they've tracked through COVID, and even before that, it's more about whether or not they've got an actual invoice available to them that we can actually provide value against, that they're sitting there waiting 30, 60, 90 days, or may even have a number of books, a number of debtors on their books that they've been waiting for some payment that we might be able to assist with. So it gives them really good opportunity to utilise that to generate that much needed working capital and perhaps assist them as part of the package with that tax debt that we were talking about a bit earlier on. Happy with startup businesses, so those opportunities, those transitions of people are selling up and whatever else, if we expect that a number of business owners may not be able to get out of it, but they may find somebody else that can take a part of their business is profitable and be a part of that. I guess perfect for today, looking at business with challenges and reduced turnovers and debts. Businesses that need a restructure or need a turnaround. We've done this in the past, and obviously we anticipate in order for many businesses to be able to transition through the COVID period, they're going to need some working capital before, perhaps through either a restructure, whether it be through an administration and out the other end through a DOCA, or a total restructure, depending on how it is. As long as it's done properly and appropriate, it's not seen as something that's been inappropriate. We're keen to look after our existing clients and businesses out there that are in that position that really was got into strife purely and simply because of the changing environment that we all face ourselves in. We're also happy to help and assist where there's limited equity in businesses and business with unique structures and customer arrangements. And we're also happy to work in with other lenders if it's appropriate and there's enough there and they're willing to work with us too. So we've done plenty of those scenarios. So I just want to say that we're out there to facilitate and assist when it comes to businesses finding working capital altogether. Over to the next slide. Just so you're aware, industries that we work in and debtor finance you can pretty much rely on in this particular areas, wholesale trade, transport, logistics, security industry, business services, wet and dry hire, manufacturing, distribution, transport's a big one, recruitment, cleaning and maintenance. So all those industries which are, I guess, reliant on payments dragging out 30, 60, even 90 days. We're able to get in there and help businesses get out of a pickle, but also grow. And there's been some great stories we know about on the positive side where businesses have been able to sort of expand at the present and they've needed our services, especially in the food manufacturing. I think a lot of us are seeing that emerge and grow immensely. Next slide. Next, Shane. So I thought I'd just do a bit of a case study just to sort of give you a bit of an idea of how it can work. In this particular instance, we had a construction business where they performed, and this is quite critical because you often hear debtor finance can't help in the construction industry. generally it is true and very difficult, but often there are completed works that can be looked at. And in this instance, it was one where they were doing a lot of the work on behalf of the builder, and providing labour. They were supplying all the formwork and all the rest of it. They were doing all that work, putting in the concrete, and they vary their way they do their contracts. So these guys work very different. So it's not all stage and it's not progress. So you can actually fund in certain circumstances. They got themselves into a whole world of pain, venturing out into areas that they didn't have expertise. They then had ATO arrears. They had the COVID lockdown on changing the work patterns and changing everything. So we were able to, if you flip to the next slide, Shane, we were able to negotiate with the bank so we can do a deed of priority. We put in a $1.1 million debt of finance facility. And it just meant that the structure, the way we did it, would allow them to free up the working capital in their debtors, inject some much needed money into the business, get themselves on the front foot, continue on with the work, and they've got spare capacity in essence also to actually to access fast cash so they can do other projects and know that they can pay their suppliers and keep on top of things, having addressed some of that legacy issue that was there. So we can move quickly. I think this one only took about 2 or 3 weeks. It all depends on the business nature of the business, and obviously in this one here we had obviously a bank that was willing to work with us and in particular look after the client. Next slide, please, Shane. Once again, another example, a logistics business, an absolute perfect example for debtor finance in particular. We're able to really, they had a big break. They had a lucrative 6-month contract. We all know that businesses don't realise that sometimes expansion can come at a cost. We're able to quickly leverage up to their needs in the receivables ledger. They had a large concentration, something we're not too concerned about. We were able to help them. Predominantly, when we look at clients, we look at the value of the people in the business. We look at how they're structured and try and work on a solution that's tailored to them, in particular using their debtors and coming up with a debtor finance package, but also, and not specifically for this client, but we were able to obviously put in the trade and equipment finance. So in this instance, they needed additional trucks. So we're able to do a package where we're able to join both the debtor finance and also put in some equipment finance in areas where often goods are not funded by many of our, I guess, top tier lenders. So people have to spend a fortune on these goods and don't always get the ability to sort of get the equipment that they need. We've actually got products where we'll actually fund older assets, and we'll actually happily do that based on their needs. And in this instance, we're able to get them in some additional trucks and some trailers that were a bit older, but perfectly suitable for the type of business that they were doing, and help them get out of a pickle. Shane, maybe the next slide. I think I already talked about the solution to finance, integrated solution with equipment finance, and we try and find both these packages. And we have, as I said earlier, the trade finance where appropriate, obviously not in this case. Another thing I'd like to highlight, and something we've been working on for many years and we've got in place, it's getting a bit tougher now, and I think many of you might see this. Insurance companies are not as flexible with their trade credit insurance at the moment. We're finding some battles there. Because of the size and scale of what we do, we're able to negotiate better outcomes and make sure that we maintain limits in place and assist our clients to make sure they've got limits and protection, especially in this day and age. But on top of that, it also, as well as it gives us comfort, it really gives them comfort that if something goes wrong, if something's a problem, then they're not got that extra added burden on their business because their debtors can't pay. And this one here was done within within 7 days. So we can move extremely quick. Next slide. I think I touched on this earlier on, so I won't bang on about it, but generally they need to have their debtors aging out 30, 60, 90 days at least, so that there's some value in there. And as long as they're waiting on that payment, we can fund up to about 80%, sometimes more in certain circumstances. So that's just a trigger point. If you can see there's a large receivables ledger, there's no other alternative, there's no other assets in the business. Could debtor finance assist your client? Is a question you can ask, and this is the first starting point to look out for something value in their debtors. Next slide. This is a bit of a table, and I think I won't go through it all, but it sort of talks about from a pricing perspective and comparable with traditional bank overdraft and perhaps other products. I mean, the key point here for me is that overdrafts are normally linked to other assets and are capped and quite often maxed out, especially when people actually need to actually utilise it most. The great thing about debtor finance is you can actually scale that up to a limit, basically supported by the value of your debtors. So if you've got a strong debtor book and you've got enough there, then generally that'll be a lot more, unless you've got other ways of securing traditional bank overdrafts. And obviously we know, and we've seen that many times, a number of businesses either have credit cards or have those short-term loans in place, which can be, if added up over an annual basis, become quite expensive. Putting in a facility like ours will probably achieve what they need, but also reduce a lot of that cost and the potential exposure to that. Next slide, please, Shane. It's very easy to apply. You don't have to get into the detail of this. Often people get concerned with the level of information required. It's relatively complex. For us, it's as simple as making a call, talking about the issues that the particular client may or may not have, and working out whether there's an opportunity there for us to put a facility in place, get the product out there so they can increase their working capital and get through the issues that they've got, or take up the opportunities that may be presented by using either of those three products. So it's as simple as just talking to us, brainstorming. We tell you exactly what information we'll need, and you can pretty much take it from there. You can be as involved or not as you like. Next slide. So that's pretty much it. It's a product that's fairly simple and straightforward. Another bonus is it protects personal assets because you're actually using your debtors and your business facility, so you're not relying on other assets. It can help you with increasing your buying power. It's a bit easier than perhaps the credit processes elsewhere. Our appetite, and I think many others, is that we're out there to engage and try and assist small businesses, and it just helps them with a lot more working capital. That's it. Thanks, Shane. Any questions?
Marvellous. Thanks, Arthur. I think there is some questions down there in the chat box, but I might let you deal with those in
Absolutely.
written format, and we'll move on to the next presenter, which is Nick, who is a partner, my business partner at Dynco. But he's got a lot more experience than me. Some might say better looking, but we won't go into that. And I won't give him I won't give him too much of a wrap up, but Nick's going to talk about alternates, like when things get really tough, the solutions that will help keep you afloat in a really distressed financial position. Once we've gone through all the other speakers that we've had so far that would have helped you if it still is in trouble, then there is alternatives available which don't necessarily result in a formal appointment, and some which do. So with that, I'll hand it over to Nick.
Thanks, Shane. For accountants and their clients, because there's significant consequences. So there's temporary insolvency law changes coming to effect in March. They're meant to expire 25th of September. They've been extended through to the end of December, 31 December. Now, the one that I'm referring to is the protection for directors for insolvent trading. In this instance, if you put the company into liquidation prior to these laws lapsing, because they are only temporary laws, prior to the 31 December 2020, directors have protection from insolvent trading for the period of the time the law's in place. They leave it a day too long and they put the company into liquidation on the 1st of January 2021, they're liable for insolvent trading. So it's something worth considering, obviously, going forward for directors as to when they do or don't pull the pin. If they've got no hope, they might as well pull the pin now. We will get out of house arrest. Things will go back to normal and we go from there. But your expenses are going to be tough. It's going to be high. It's going to be high. It's going to be tough. So if you flick the slide, thanks, Shane. Now, these are all obvious things that everyone else has spoken about, but it's worth repeating. People don't like being kept in the dark. Communicate with your stakeholders. They don't like surprises. So that's your banks, your landlords, the tax man, suppliers, employees, and seek advice from qualified advisors, your accountants, your solicitors, and your insolvency practitioners. When you do get that advice, make sure it's proper advice on the basis that you've got proper information. There's no use having books and records which aren't up to date, wrong figures, wrong information, wrong decisions. So that's just an introduction as to where we go. But how do you survive? If you flick this slide, Shane, we've got some options for people. How do you sail into the sunset? Well, there's three options there we're going to talk about tonight. One is safe harbour, two is deeds of company arrangements, and then the third one is Josh's reforms. So we flick the slides again. The first option is safe harbour. That was introduced in September 2017 and was meant to be reviewed after 2 years of implementation. Now, I'm clearly no good with computers, but I'm pretty good with maths. I can tell that 2 years have passed, 3 years has now passed. There's still been no review, but it's not the first time the government said they're going to do something that they haven't. The reason that the laws were implemented was basically people thought that by putting a company into administration and it was struggling, it cruelled the business and its chance of being restructured. So what Safe Harbour did was encourage directors to remain in control of the business that was in financial distress without the publicity, so it wasn't publicised, and it then protected the directors when they did it correctly from being personally liable for insolvent trading. Now, it's not disclosed, it flies under the radar. If you're listed on the stock exchange, you don't need to notify the ASX. So that was the introduction or the purpose for it. If we change the slide. So when does it start? The person or the directors in this instance, they need to develop one or more courses of action that are reasonably likely to lead for a better outcome for the company. Now, when we talk about better outcome, that means an outcome that's better for the company than the immediate appointment of an administrator or liquidator. Now, that course of action can be varied, it can be flexible, but it needs to be monitored on the way through. To qualify for Safe Harbour, if you flick the next one, Shane, there's a number of criteria that need to be met. The first one on the slide here is that you need to be up to date with payment of your employee entitlements. Included in employee entitlements is obviously superannuation, and that knocks out a hell of a lot of companies because, surprise, surprise, that's often not paid. The next thing you need to do is be up to date with your taxation reporting obligations. So not necessarily payment, but everything needs to be lodged. You need to be compliant with your usual director obligations, maintaining proper books and records and the like. And you also need to appoint an appropriately qualified entity. Now, there's no strict definition as to what that is, but clearly the most appropriate person would be a registered liquidator. They've got the experience, they've got the knowledge. And we talk about developing a course of action, as we indicated before, something that's going to offer more than what happens in liquidation. Now, whilst we indicated that Safe Harbour is not publicised, therefore we don't know how many have been done, how many have been successful, how many haven't. What we do know is that we at Dyneco have done a number of these engagements, a number of them have been very successful. I can talk about one of them just briefly, given that it did actually go into administration, which wasn't a bad thing. It's the Roger David group of companies, which if we had been appointed liquidators straight off the bat, the employees would have got paid in full, the bank would have got 50% of their money, and unsecured creditors nothing. So we oversaw a Safe Harbour regime which ran for 8 or 9 months. We oversaw a restructure process when the number of stores were reduced down from over 100 to approximately 50. Other measures were put into place, but it did come to a point in time where the course of action was no longer able to be sustained, and the most appropriate course was to then place the company into administration. The effect of all that, though, was that employees got paid in full, the bank got paid in full, and a deed of company arrangement was put forward whereby creditors got 15 cents on the dollar as opposed to zero. And the silver lining for the directors was that when the administrator does his report, he talks about the good, the bad and the ugly, what they get in a liquidation, and liquidators can recover insolvent trading. But in this instance, it was pretty easily determined that they did all the right things, they did their safe harbour and therefore protected for insolvent trading. So that's an example of where safe harbour comes into effect and is a good option in these circumstances. If you flick to the next slide, Shane, we'll compare that to a deed of company arrangement, which is a more formal process. So it's obviously publicised. The administrator takes control of the business for approximately 4 weeks. During that time, he runs the business, he trades the business if required, and does a review of its affairs, and then does a report to creditors. That report will provide the options to creditors as to what they'd get in the liquidation as opposed to what they'd get under the proposed deed. Now, the terms of the deed can be anything. If you don't mind just flicking the next screen, Shane. But certainly in this environment, a holding deed of company arrangement could come in handy. Certainly coming out of COVID-19, businesses aren't going to have magnificent cash flow, and therefore they might want to put a moratorium on debt for a period of time to enable them to get on their feet and then pay money down the track. Now, the terms of the deed, as I said, can be anything: payment in full, payment in part, payment in time, payment on the knocker. Now, obviously, creditors want their money too, and they're going to be needing money as well. So one of the options is, in respect of a deed of company arrangement, is to finance the contribution sum. So whether it be Stephen or Arthur, who both spoke earlier, or other financiers, both those two I know have the capacity to finance deeds of company arrangement, which means that your creditors can get paid in full. It's a much better sell, bird in the hand is better than two in the bush, and away you go. The deal is voted on by the creditors, and if it gets up and is successful, the management is returned to the directors. So they only lose control of the business for about a month when the administrator is running it, and then the deal gets through, they control it, and all creditors are bound. So that's an option to safe harbour, and we now have a third option. If you flick the slide, these are Josh's reforms. Now, these are just hot off the press, just been released, and clearly Josh has been a little bit lonely and a bit bored during isolation, probably sick of homeschooling, went to the garage, maybe to look for a hairbrush to relive the good old days, not too sure, but he stumbled over a dusty box, which was labelled Small Business Reforms 2014. Like all good politicians, he stuck his nose in and had a look and thought some of that had some good ideas, and he'd claim them as his own. So he retitled it, made some tweaks, and that's proposed now to be legislation on the 1st of January 2021. So it's based off some proposed amendments by Rita back in 2014. I say there on the slide there's been no consultation with industry bodies. I do tell a lie. An explanatory memorandum was released yesterday, along with draft legislation. We still haven't seen the rules or regulations that apply, and we have until Monday to lodge submissions to advise whether we think that it's a good idea or a bad idea. Clearly, it's a good idea. It just needs to be implemented properly, because this is permanent law, it's not temporary law. So you want to get it right, and things done in haste have habits of having holes in it, just like a piece of Swiss cheese. So it's important that we do get it right, and there's a very narrow opportunity for consultation. If you don't mind just flicking the slide, Shane. So to qualify, from what we understand, for this small business reform, and bear in mind these numbers are based on the rules and regulations which haven't been released, but what we've been led to believe is the company to qualify needs to have liabilities of less than $1 million. The company tax lodgements need to be up to date, so that's your tax return and your BASs. Employee entitlements that are due and payable must be paid, similar to safe harbour. That includes superannuation, which may well knock out a lot of mum and dad type companies. It's also proposed as a protection mechanism that directors can't use this process more than once in a prescribed period of time, which is proposed to be, we think, 7 years. And if it's found that there is misconduct, such as Phoenix type activity, the process will convert to a full liquidation. If you flick the slide, thanks, Shane. So this is a debtor in possession model. What that means is when the proverbial hits a fan, the directors continue on and continue to control the business in the ordinary course of business. But what they do is engage with what's called a small business restructuring practitioner to implement a restructure plan. And they've got 20 business days to do that. Who can be a small business restructure practitioner? It's a mouthful. A registered liquidator is the answer to the question, although they are indicating that there will be a separate class created of a new registered liquidator who may have lesser qualifications, but we don't know because that's in the rules and regulations. So once the plan's implemented, that's sent out to creditors. The administrator charges a flat fee for that. He makes a recommendation to creditors together with a certification as to whether the business can meet these obligations and also whether the affairs of the company have been properly disclosed. If you flick again, thanks, Shane. So there's no meeting of creditors, similar to a creditor's voluntary liquidation. Creditors have 15 days to vote on the proposal, so there's no meetings. It requires at least 50% of creditors in value to vote in favour. Related parties aren't entitled to vote, another safety mechanism. And if accepted, it's the administrator that dishes out the money to the creditors pursuant to the terms of the agreement. If you'd like to flick that around too, thanks, Shane. So the proposals here were made because I thought voluntary administration was too costly and a little bit too chunky. So this is the solution. It's a more streamlined process. Interestingly enough, though, it's actually a longer time frame than the voluntary administration process. From a practical point of view, the major difference is that the director continues to control the business as opposed to in an administration where the voluntary administrator controls the business, runs the business, but he's also personally liable when he does that. So obviously there needs to be checks and balances in place. The question is going to be, are directors going to be personally liable for the debts they incur? And even if they are they going to have the capacity to pay? The bigger question though is, will creditors continue to supply the company, given that they've already had the company spend their money once and not pay it? Or will they require COD to continue the supply? So that's the question there, or the practical issues there. If you flick the slide again, thanks, Shane. Another new proposal is a simplified liquidation process. So it has the same qualifying criteria as a debtor in possession model in respect of less than $1 million, employee entitlements and super up to date, lodgements with tax up to date. If creditors oppose this process and 25% in value oppose it, it will revert to a full-on liquidation, not a light liquidation. This is meant to be a cheaper model in that the liquidator won't be able to pursue unfair preferences that can be clawed back from unrelated creditors. You won't be required to report to ASIC as much as ordinarily in the full liquidation. There are simplified voting procedures and simplified dividend processes and other cost savings measures is what is proposed. Good idea in principle, but the devil's going to be in the detail, obviously, going forward. So there are three alternatives available to companies in trouble. We know there's going to be a lot of companies in trouble. We were speaking to people in March who were in trouble and they've just kicked the problem down the road. Certainly look at the options. It's not a one size fits all. Different companies, different circumstances will require different solutions, but the key is to get advice and then make informed decisions. Thank you.
All right, thanks for that, Nick. All right, now, last but not least, Luke Egan from Astor Alliance, who is going to talk about a fair bit about the construction industry, and he has a bucket load of experience in that industry, especially helping those with the pitfalls and some of the distressed sites and things like that. And I'm sure we've all got clients, friends, some connection to the construction industry, and it's another one that's been heavily affected during this current crisis. So I'll now hand it over to Luke. Thank you, Luke.
Thanks, Shane. Good evening, everyone. Very informative panel so far. I'm sure everyone's taking a lot out of it. From a personal perspective, it's been brilliant. This is probably the longest period of time I've spent from my missus and the little puppy in 6 months. So, yeah, it's been great. But today, I'm going to give a solid overview of what's going on in the industry in the moment in relation to payments and so forth. I'm going to use some practical examples, and then post that, I'm going to provide some ideas and solutions on trying to recover debts and also mitigate, find ways to mitigate payment issues arising, and giving you some practical examples on those as well. So, way of introduction, I'm the director of Astra Alliance, and our business services the property sector. It specifically has 2 service streams. Shane, is the slides on at the moment? Thanks, mate. The 2 service streams that we have is one department we deliver construction and building services. Now that could be, it's included of facilities management, building, construction, refurbishments, fit outs, new builds and maintenance. And then on the other side of our business, we have a debtor recovery side, which works with lenders, insolvency practitioners and lawyers on the recovery of property and realising those assets when in possession. To give you an example, Steve Mitchell's Oak, I'm sure he's going to have lower arrears, but if he had a property where he needed to engage lawyers and to take possession, he would engage a business like Asta to realise that asset, do a clean-up of the site, put the property on the market and effectively see it through till settlement. Today, the key section is the payment issues in the building and construction and development space, and there's 4 key areas that I'm going to cover off on. Next slide, please, Shane. Those sections are the paper trail for completion of works and variations, distressed developments and building sites, defects and retentions, end of lease make good clauses. So starting with number 1, paper trail, I'm sure we're all aware we've had clients in the past who, with paperwork, isn't probably their priority being on building site. Now, this could be for a number of reasons. It could be poor administration on the back end. It could be a trusting relationship with a client, and paperwork is left second fiddle to any of the work that's happening. Now, the pitfalls of this administration not being put through, it can create huge issues with payment. Number 1, substantiating your payment claim when coming to the point of invoicing. And number 2, if all that documentation isn't in order correctly, there is little chance of recovery if you do decide to take recovery action. Next slide, please, Shane. As an example, Asta represented a client in the past. Our client delivered a building upgrade to a hospital across 12 floors. At defect stage of the project, the CEO decided the hospital wanted to install ZAP tip units on the floor's kitchenette, not standard tapware. Asta's client took instructions verbally and in good faith and installed 12 ZIP units at a cost of $48,000. When the payment claim was submitted, it was rejected by the hospital's finance team. Now, there's a couple of points here that we have to look at. Number 1 is that the contractor did not follow through with any written authority at any point. He trusted the relationship with the hospital and went off verbal instructions. Number 2 is at the completion of the project, the contractor we represented, didn't consult with the project manager relevant to the project. If he had have pulled the project manager aside, a work order could have been raised at that stage and the payment claim wouldn't have been rejected. Now, fortunately for this contractor, they engaged Asta to remedy the issue and were able to work out a solution with the hospital and receive payment. But while doing that, we're able to educate the contractor about the pitfalls of not having the correct paperwork and ensuring that was to occur, whether it was a small work order, fixing a downlight, right through to building a new home. And to this point, this particular contractor hasn't had any issues in relation to payment due to ensuring that their paperwork is always in order. Second section, distressed developments and building sites. I'm sure we've all been privy over the years of sites that have had liquidity issues, or there might be some disputes between different parties on certain projects. What people need to understand is on these major projects, especially on the 5 million plus mark, whether it's civil engineering, building, there is always 6 to 10 organisations who might be involved in the payment chain of the project. Now, with this in mind, this would mean that the contractors and the subcontractors on these projects are at the bottom of the food chain, and the liquidity issues that are associated with that project would mean that payment terms would drag out further and further. Next slide, please, Shane. As a practical example, Astor was appointed on a development site for a distressed townhouse development in Chelsea. Astor was appointed by a lender to find outcomes on the following key deliverables: the progress stage of the project versus the plans, the reconciliations of payments to suppliers, and advisory on completing the project with the incumbent builder or change of builder. Now, why I've mentioned this is, in this particular example, Astor was able to ascertain the issues associated with this Chelsea project and report back to the lender on the payment issues. And pretty quickly, those issues were resolved and payments were made. This practical example can be applied for any major project. If you have a contractor or a subcontractor that you're representing, there are ways to go around in a professional manner and talk to other key stakeholders on a project. If you're, as an example, working for a builder, you might be able to consult a QS or the architect. People up that line of the chain can communicate with the right people, and a payment resolution can occur. The next section is defects and retentions. Very common in the building industry that defects are used as a tool to hold up payment. This is commonly used during a project or at the end of a project in DLP period, better known as the defect liability period. Now, a defect liability period would last for a 12-month period for a project, and it's traditionally on a tier 1 or a tier 2 site. What that also means is the retentions are held in trust until that point. Very important for building contractors and maintenance contractors alike, that if a client issues the notice to remedy defects, it's important that they remedy those in the appropriate time frame, as they will be able to substantiate any payment claim further down the track. The same applies for retentions. If a contractor can remedy any issues during the DLP period, payment should be made immediately post retention release. The fourth section, and I put this in here today because I thought it would be very important with everything going on with COVID-19, but the end of lease make good clauses. A lot of what's happening out in the market is landlords holding security bonds. And when lease breaks occur, the lease fees have to be paid out for the rent, but the make good clause is also contributed as well. In essence, at times, some landlords will use their preferred builder to put costings forward for a make good, where a make good might only cost $40,000. The preferred builder might charge $80,000. Now, if tenants don't understand their lease and the obligations in their leases and review them effectively, they can be heavily exposed for these exorbitant costs. As a practical example, Astor had a customer who was a tenant in a commercial office who broke their lease early due to expansion and was moving into a larger facility. The existing lease had 3 months remaining and a make good clause. The landlord decided to hold the $310K security bond in full with only $45K of rent owing. The landlord claimed the make good was going to cost in excess of $80K. Now, Astor was able to ascertain pretty quickly that the make good cost was roughly around $19,000, and the majority of the scope items were actually base building. We were able to consult and we were engaged, and we delivered that, and the majority of the security bond was returned to our client. Next slide, please, Shane. In this section, I'm going to quickly talk about some solutions to recover debts without having to go down a legal path. First and foremost, credit checks and DD on a potential customer. This is something I've done for years personally. In the first instance, speaking to relevant subcontractors out there in the marketplace, finding out if this particular client they want to work for is paying on time, do they take deposits, has there been any liquidity issues on their projects. Further to that, you can do a formal check through Equifax or Baycorp just to tick all your boxes before working with that particular customer. Number two, deposits and progress claims. Very important, especially in this market at the moment, is claiming deposits and progress claims as much as you can through a project. Whether it's a small or large project, the ability to claim right through will ensure that labour and material costs will be covered in the event there becomes a payment claim issue. Building permits, this is a big one. A lot of builders will sometimes, they'll see a grey area where they're having to issue a permit. I would say, especially in this market, you would always issue a permit which will ensure that you have control over the project. If there does become a payment dispute, the costs involved in changing a permit and certification of any building works is astronomical. In some cases, can be up to 50, 60%. Holding that building permit gives greater control to the client and ultimately to get remedy their payment. Another good tool is using the PPSR on goods supplied. Just like purchasing a vehicle and a lender takes out a security on that vehicle, the same can be done for building trades. As an example, if you've got an electrician who's supplying $50,000 worth of downlights, you can register a PPSR on those downlights and you will have security over the lights until payment is made. External project management or quantity surveying to review project and come back with recommendations. I touched on that with the Chelsea project development. It just gives greater clarity and opens up a lot of issues that can be resolved and to find out if both parties can move forward. The final one is substantiating a claim with SOP, which is the Securities of Payment Act. I would suggest seeking legal advice on this, but in essence, if a contractor hasn't been paid and he issues a claim under the SOP Act, endorsing SOP on his invoices, the respondent has to respond within 10 days and communicate any issues with the work, or the invoice becomes due and payable. Next slide, please, Shane. Seeking further legal action, and again, always seek legal advice. I know some great law firms on the East Coast, so if anyone wanted any recommendations in regards to that, I'm happy to share. Enforcing of SOP, and that can be done through a complaint with the VCAT or the magistrate, and issuing a statutory demand notice. And again, seek advice. Originally, statutory demand was 21 days, as Nick touched on, but is now at 6 months. So where ASTA can help is in a lot of areas. Obviously, we can offer construction and building advice to clients. We're there from a banking perspective in the recoveries area. So whilst we are working for lenders, insolvency practitioners, and so forth, we can work with borrowers who may be in a little bit of trouble and they need a little bit of advice. We also have some good relationships out there, and we might be able to give them some tools to work through those issues. I hope it's been informative for you all, and good luck for the future.
Awesome. Thanks for that, Luke. Greatly appreciated. All right, that brings us to the conclusion of our webinar. And I'd like to thank all the attendees for registering and being part of it. I'd also like to thank all the panelists. One thing that a couple of thoughts I'd like to leave with is obviously one thing that Dan keeps saying is that we are all in this together, and that I do agree with. We have had a health crisis that's given birth to a financial crisis, and by having larger network of people and people that you can rely upon or call who may know someone else is going to be paramount in helping businesses get through and survive this financial crisis. So we hope you found it all informative. If you've got any questions or things that you want to hear from the panelists directly, obviously make contact with whoever you know, and they can put you through to each other. We all know each other, so would love to hear from you. If you've got any other feedback, love to hear that as well. And we thank you for your attendance.